This is a video on Walgreens, part of the continuing feature stock series. The date of this review of Walgreens is September 4th, 2018. All right, to get started with, looking at the price momentum over the last 3 months for Walgreens, it's remained about even with the overall market, but actually this is a good thing because previous to that, there had been a little upheaval around Walgreens dealing with Amazon making an announcement several months ago that they were getting into the online pharmacy business through the purchase of an established vendor in that space, and it drove Walgreens and CVS and other pharmacy type retailer stocks down considerably. Walgreens was down almost 10% soon after that, but it's since then recovered nicely, and you can see here over the preceding 3 months it's actually remained even with the overall market. So that's a good sign that there's some good resiliency there and some positive attitude towards Walgreens by the market. All right, as far as valuation, the first main input value to be looked at is the sales growth. And notice here that the default value for sales growth is 18%, which is pretty high when you consider the industry average is 9%, and then most S&P 500 stocks are typically forecasted to have 3 to 5% sales growth. So we want to look into that. So I'm going to come down here and head off to the CNN site and see what kind of sales growth they're referencing out here. If I go into the forecast tab, I will see a reference to at least the analysts that they include in their assessment shows about 11.5% sales growth, so that's a little less than what Polaris is showing. The growth of earnings is 17.5%, which is pretty steep. Shows that earnings are going to go from right around $5 next year. They're looking to be all the way up around $6, and from there continue to have a pretty good growth. So anyway, if we go 17%, go back to this, or 12% from this, 11.5% from this site, and then compare it to the 18%. First thing we want to do is just slide it down to see what kind of sensitivity there is to growth, and it does lower the growth pretty considerably. Well, when you consider you're lowering the sales growth by 33%, the practical investment return drops pretty significantly. So some work would have to be done there before you make an eventual decision on this stock. But for now, I'm going to keep it with the 18% growth, knowing that that's probably a little steep, but until I have time, until more research is done, that's going to be sufficient for this review. So looking at some of the other input parameters that are used, the profit margin. Notice that the company average profit margin historically has been 3.5%, and the projected profit margin 5 years out, the future profit margin, is also 3.5%. And for an established, stable company like Walgreens, that's in line, so I don't see any reason to consider a different value than 3.5%. The profit, or the price per earnings ratio, seems a little light for an established retailer, pharmacy retailer like Walgreens. 15 PE is a typical kind of normal down the middle PE ratio. Anything below 15 usually indicates that the market is assuming additional risk of the cash flows, therefore not as certain, drives the PE down, or it could even be that there's negative growth being assumed by the market. I don't see the market assuming any kind of negative growth, so I would think it's maybe more to do with riskiness. Now, come up here and look at the historical implied riskiness using the 7.5% as the required rate of return by the market. The 7.5% is about equal to a 15 PE. So this is implying more like an 8%. So I think this should be raised up to at least 15. And then the next thing with a PE is whether there's any, once here we are in the 5 years out looking at the PE and we're assuming stable conditions, whether Walgreens would be one of the few companies that has enough brand recognition and that kind of thing to continue to earn an above rate of return, which would be above 7.5 or 8% was ever being assumed 5 years out. And without going through the math of how that impacts into the PE, usually a company that has some unique brand where they will be able to get above market rates of return well into the mean reverted period. It's usually from a brand, some kind of patent, some kind of government regulation, something that really restricts competitors from coming into the space, and they're able to maintain above equilibrium rates of return on their investments. I want to assume that Walgreens has such a situation like that, and a typical bump in PE is about a 5% bump in PE. So with already a PE that probably should be more around 15 divided by 14.2, that's an increase of about 5.6%. And I multiply that by another 5%. It means the total increase in PE would be about 10%. And then if you watch other videos, particularly the closer look videos on how to indirectly modify the formula by using the sales growth slider, you know that if we're going to assume a 10% increase in valuation, you just move the sales growth slider till you see 99, 100 kind of valuation. So I'll stop there at 97, and that would bring us up to a practical investment return of 14.8%. Now, looking at some of the other input parameters would be the share issue trend. A normal issue trend is about 1.8%, and here they are. Now that's net, so it includes both repurchasing for any kind of stock option, stock award kind of things going on with their employees, plus just floating out buybacks, all that kind of activity. It's net of that, and so this is right in norm with an established company. So 1.5, not going to change that. And about the only other parameter worth considering is whether this exceptional growth that we're assuming of 18% plus a little bit of bump now for an expanded future PE. It would be whether you believe that the 18% growth would continue on past 5 years. Well, I'm not going to go with that because I think, like I already mentioned, Amazon's coming into this space, and I think there's enough continued pressure on this industry that they're not going to be able to sustain high rates of growth forever. At best, that they're going to normalize and continue to have a little bit above market rate of returns, but nothing like 18%. So, all things considered, the fact that price come down a little bit even as recently as today, this looks like a definite prospect. And if anything, spend a little more time on sales growth assessment, but on a cursory look, going with the prospect. Thanks.